Technical analysis helps investors make probabilistic decisions by studying price, volume, and patterns that reflect market psychology. It doesn't predict the future with certainty, but it provides a structured framework for identifying higher probability opportunities, managing risk, and timing entries and exits. Below is a practical, step-by-step approach you can apply to incorporate technical analysis into your investing process. Begin with a clear plan. Define your objective and time frame, short-term trading, swing trades, or longer-term investing, as different horizons call for different charts and indicators. Decide your risk tolerance and position sizing rules before you look at charts. Technical signals work best when paired with disciplined risk management. Finally, choose the markets and instruments you understand, whether stocks, ETFs, futures, forex, or crypto. Set up your charts and tools thoughtfully. Use a reliable charting platform that offers multiple time frames, indicators, and drawing tools, and always work with at least 2 time frames. A higher time frame to identify the primary trend and a lower time frame to time entries and exits. Keep your indicator set small, typically a trend indicator, a momentum indicator, and volume to avoid conflicting signals and information overload. Master the core technical concepts that underpin most setups. Identify trend direction by looking for higher highs, lows, or by using moving averages. Recognize support and resistance as horizontal price levels, where buying or selling repeatedly appears, and treat breaks and retests of these levels as important signals. Use volume to confirm move strength. Rising volume on breakouts suggests conviction, while low volume breakouts are suspect. Moving averages, whether simple, SMA, or exponential, EMA, smooth price and highlight trend direction. Common lengths are 50, 100, 200 for longer term, and 9, 20 for shorter term contexts. Momentum indicators like RSI, MACD, and stochastic help spot overbought, oversold conditions and momentum shifts, while volatility measures such as Bollinger Bands or ATR help set realistic stops and position sizes. Learn common chart patterns, triangles, head and shoulders, double tops, bottoms, and flags, and treat them probabilistically, not deterministically. Follow a disciplined workflow for each trade. Start with top-down analysis on a weekly or daily chart to identify the prevailing trend and key support, resistance zones, and confirm that the asset fits your investment horizon. Define levels by marking major support and resistance, trend lines, moving average clusters, and prior swing highs and lows. Then look for setups on your trading timeframe that align with the higher timeframe bias. Examples include a pullback to support in an uptrend or a breakout from consolidation, accompanied by rising volume. Require at least one confirming indicator, such as momentum turning up, a MACD cross, RSI exiting an oversold reading, or a volume spike. Plan your entry and exit in advance. Specify entry type, market, limit, or pullback, a stop loss level, below support, an ATR multiple, or where the pattern is invalidated, and targets using risk-reward ratios aiming for at least 1 to 2 or better. Size the position by calculating distance to the stop and limiting capital risk per trade, commonly 1-3% of portfolio. Execute and manage the trade with trailing stops or by scaling out of winners. Avoid moving stops further away to justify a bad trade and reassess the position when signals change. Afterward, log the trade, review outcomes and rationale, and periodically backtest and refine your rules. Risk management and psychology matter as much as setup quality. Treat technical setups as probabilistic. Even the highest quality signals fail sometimes, so expect losses and size positions to absorb them. Limit emotional interference by following predefined rules and using automated orders where appropriate, and keep a trading journal to learn from mistakes and reduce subjective bias. Watch out for common pitfalls. Overtrading driven by too many indicators or chasing setups erodes edge and increases costs, so be selective. Confirmation bias can lead you to force charts to fit a view, so require objective confirmations, and curve fitting in backtests produces misleading results. Optimize parameters on historical data, but test on out-of-sample periods, and forward test with small capital first. For longer-term investments, don't ignore fundamentals. Combine technical timing with fundamental analysis to avoid structural risks. Combine technicals with other inputs for a fuller picture. Use fundamental analysis to select quality assets and technicals to time entries and exits, and monitor macro factors, interest rates, earnings calendars, and news that can quickly invalidate technical setups. Start practically. Keep a small watch list and practice spotting trends and setups. Learn one reliable indicator or pattern deeply before adding more, and backtest systematically, while paper trading or trading small sizes until you're comfortable. Technical analysis is a tool set, not a silver bullet. When combined with disciplined risk management, a clear plan, and awareness of market context, it can materially improve timing and decision-making in your investments.